I want to ask some fun, bullish questions, but I also want to ask some doom and gloom FUD questions. Audience, what do you guys think we should start with? Fun or good or bad stuff? Thumbs up, thumbs down. Bad. Okay, we got a bunch of bad. Wow, everyone bad. Negative. You guys are tired from all the conference days, huh? All right. So, what are the biggest risks with these DATs? Are these gonna implode and they all get liquidated? And is this gonna be blamed for the next bear market? Or is this this new emerging kind of sub asset class that will just keep growing and maybe it'll have some turbulence? And if so, like, what's the biggest risk, either of you guys?
Yeah. So I don't think there's like a large inherent risks in these DAT structures. So I know a lot of people are kind of like, okay, it's this hype. It feels like the old 21 days when we had FTX and Luna, and I think that
I said that to someone yesterday. They were asking about some parts of this, and I was like, they were talking about a specific DAT and what they were doing, and I was like, that kind of sounds like FTX and how they were holding their own shares and
yeah,
commingling.
right. I mean, there's the opportunity for similarities, but inherently it's not a risky structure, because what most of the DATs do, they basically hold certain assets and they offer in a way a derivative to that asset, but it's usually fully collateralized, or there's like very small leverage. Most of them, they don't have a lot of leverage, and if they have leverage, it's usually like in a very low risk manner. If you look for example at the most like sort of famous or infamous, depending on how you look at it, one MicroStrategy. But like the worst thing that can happen is like that their asset value is here and their premium becomes a discount and the share value is here. But there's no risk to like underlying markets or the underlying assets, because like it's just a derivative, like the asset will trade how it trades on the normal markets. And then the worst thing what can happen to a specific DAT is that it's like gonna be at a discount for a long time, or there's like mismanagement, large cost structures, embezzlement of funds, loss of funds. Of course, that's just normal risk that you would have with any project. Like I don't think there's sort of this hype. Of course, yes, there's a lot of capital going into these assets that can kind of create like an overvaluation in the underlying assets, but it's not creating an additional risk like FTX or Luna, where there's like money going into something that has no underlying value, and then it's kind of being loaned out to another party, to another party, to another party. There's nothing of that inherently in the DATs, in my view.
Yeah, no, I would agree. I would just say that I think you might be underselling the number of DATs that are doing some of these more creative structures now. And if as it gets hypier and hypier and hypier, you're going to see more creative structures that are kind of maybe causing a little bit more risk. And to Rock's point, like if one of those blows off, or if there's a really called a mass market pullback, then they probably all will get blamed at some point, right? They'll just be kind of painted with one brush. But no, I do agree. I think it's inherently, there's nothing wrong with the structures. It's just how the structure gets abused and some of the more creative TradFi, call it, financial engineering models that some people apply with collateral, etc. So, but no,
I think one good thing is that they are largely more regulated entities as Nasdaq MP, so it's much harder also to do something like an FTX or a Luna. Like one of the big advantages for them was there was no oversight. They could just like do anything.
All their structures have to be SEC approved or as regulator approved, etc. So no, I totally agree.
All other rules. So you guys, Ashley, why don't you guys intro yourselves so people know who you are, and then
tell us what are the rules. Like, if I own a DAT, or if I'm the CEO of a DAT, could I just go 100x Bitcoin on like some protocol? Is that allowed? But yeah, go intro yourselves first, please.
Shall I start, or you want to start this time?
Yeah, so my name is Zane Callion, Executive Chairman of Luxfolio Holdings. We are the first Litecoin DAT, first Litecoin treasury, before DAT was even really a term that was widely used. We have the direct support of the Litecoin Foundation. Charlie Lee sits on our board alongside David Schwartz.
Big supporters of Litecoin, very convicted in Litecoin as an asset. And yeah, we were kind of we were a pioneer in Litecoin specifically. We're kind of I'd say definitely on one of the more conservative side when it comes to DATs, because we are pure equity. We have no debt on our balance sheet, no creative structures, basically just issue equity to raise more, to buy more Litecoin. And I'd say our model is a little bit kind of unique in that our core mission and our core value, our core goal is to foster the adoption of Litecoin. That in itself will flow down to our shareholders. We provide value to our shareholders by doing so. And that extends to being a really integral part of the community. And that's really a big focus of what we try to do, is be not only call it just a treasury, but also an anchor community as a bank, be able to invest in community projects, be able to help foster development of the community, and really, at the end of the day, drive adoption of Litecoin.
Cool, nice. So I'm Tommy, co-founder and CFO at Beam. At Beam, we focus on creating gaming primarily, but also AI and DeFi products. So currently, we have one of the largest treasuries in the Web3 space. So we're currently sitting on about a little under 200 million in non-native assets, so $200 million of value. A lot of that is in BTC, Ethereum, stablecoins, and then also a lot of venture investment and some other tokens.
You're a gaming company?
Yes, it still exists. No, we're not at that. So, okay, to clarify, Beam is not a DAT. Maybe we'll get one, maybe we won't, like, who knows? So we're a top 200 Web3 company, and we've been around since 21. And back then, we started purely gaming. And we built out one of the fastest layer ones, tailored to gaming, with like a range of products that are custom built for games. And one of like the most important one is the in-game NFT marketplace, which we believe is like one of the best in-game NFT marketplace there is. And we really think, that's at least from speaking to a lot of games, this is what they need and this is what they want, and this is what it takes to turn normal Web2 games with revenue into Web3 games. And then we also set up a large incubator accelerator fund with an exclusive partnership with Abu Dhabi. So that's also very much focused on those same categories. We also have a lot of sort of joint venture partners where we incubate / co-found a project like Sophon, Dreamcash, and Flair, and a few others, where we have like anywhere from 20 to 50% stake. And the idea is,
So you incubated, or what did you do with Flair?
with Flair, so with Flair, so for example, what we do is like we really position ourselves as Web3 infrastructure builders, but also a foundation that knows the A to C for setting up a Web3 project. So anywhere from like the go-to-market, legal, and then of course Web3 infrastructure. So they come to us, they say, we have this amazing idea. We have an amazing team, but we struggle with the Web3 element of it. That's where we found some really interesting partnership where we say, okay, listen, let's do this together. We're going to do this part, the Web3 part. You're going to do what you're already good at. And that way we're going to amplify each other, and we put it in a joint venture structure. And that's a good way for us to like sort of get more projects onto our infrastructure, but also to kind of diversify our sort of treasury and portfolio of assets into different categories, because we have like some in AI, we have some in DeFi, and then a lot in gaming. And our model is such that we have the Beam token, and all the proceeds, like the value we generate from this ecosystem, so from these partners, but also directly from treasury investments and from the infrastructure, like the L1 fees and the in-game marketplace fees, it flows back to the token holders, either directly or indirectly. So we use it to grow operations and the treasury. So we grew the treasury from 100 million to 200 million. So since day one, we've actually been cash flow positive. And then we also buy back and burn tokens, and we distribute non-dilutive. So not from inflation like a lot of projects do, staking rewards to Beam stakers. So why do Beam stakers stake? They stake with validators to secure the network. And that's sort of our philosophy that like ultimately these token projects, they should have a way to generate revenue first and then to bring back that value to the token. And in my view, the only reason also, well, first to start a token should be that, but also if you don't have any of those aspects, either token economics or revenue, you're not in a maturity stage where you should be thinking about a DAT, because you're just gonna package something that's basically like a high risk venture startup, and then you suddenly have two vehicles that like one like both have a cost structure and probably like won't exist in for
So what going back to the question, what are the most risky things? I guess maybe producing, since you were operating a DAT, an official DAT, what are the riskiest things from your internal standpoint? If you were a bad actor or just a high risk gambler, what could you do, or what could some of these DATs do depending on their jurisdictions?
Yeah, like I think depending on your jurisdiction, you can get away with some creative structures from a debt perspective, and it can create an inherent risk where you have so much leverage that if the underlying asset itself decreases in value to a certain percentage, it can do a lot of damage to your treasury, right? So specifically structures where you're saying, okay, I'm going to raise $100 million, I'm going to go buy $100 million of X asset, and that's going to be fully collateralized on the existing asset itself. And so that's basically just a debt position where it's not equity, it's not effectively equity, it sits on the balance sheet as debt. It allows you to increase your treasury size, but if you get a massive shift in the price of that underlying asset, it really comes down to what the conditions attached to that debt structure are. And I think some people have more creative structures there, and some people are a little less creative, like more straightforward, where they're more the company's more protected, the DAT's more protected, and therefore the shareholders are more protected. But there's also the opposite to that too, where you have more predatory lending practices and kind of models that can cause a lot more risk to the company and the shareholders themselves. And I think I wouldn't necessarily say bad actors, but you can get away with a lot as long as it's disclosed, right? So like the regulators will approve a lot of kind of weird, wacky structures so long as you fully disclose them and investors are willing to invest in them. And when you're in a cycle like we're in today and you get a lot of hype and you have kind of people just piling into these things, people will take advantage of that. And
a lot of people are kind of overlooking some of the wacky stuff because the price is going up. Exactly. But when the price stops going up and the premiums start to collapse, you're going to get lawsuits.
And then that's, to me, like the risk in the space is that, there will be a pullback. But I would also say that the benefit in the space is the fact that you have, let's call it 75% of the sector, 75% of these structures, they are well built and they do have tangible assets on their balance sheets. So when there's a sector-wide kind of pullback, whether that's a full blow up or kind of a correction or whatever that may be, you're going to have these companies that still have underlying assets that have true value. And in most cases, depending on the token, obviously, they're going to be liquid. So you're going to have structures that I actually think will evolve. I think as the DAT space evolves, I think there's going to be a little bit of a reckoning or correction here in the next 6 months. But what I think you'll start to see is you'll see that these companies start to get a little bit more creative and start to look at cash flow opportunities, ways that they can leverage beyond just call it staking and generating a yield, being a little bit more, building business lines that are a little bit more developed. And I think that's how they'll diversify. And then specifically for, let's say, like pure play DATs that are focused on one asset class or one specific digital asset, they have the opportunity to do a lot for that specific asset class itself. So investing back in it, helping foster growth, helping develop it, and providing, call it a diversified exposure, not just the underlying token and whatever yield can be generated on it.
All right. I want to take a question from the audience. If anyone has one, we got 1 more minute. And if you guys don't, I'll ask it another question. Yeah.
Please do not see every in his break. It is
like categories of DATs.
I think like sort of in a way they're all trying to do the same thing in the core, right? Like they usually say, okay, we really like this asset and we want to accumulate as much of it as possible. And then within that, you sort of have the flavors of more risk, less risk. So if you look just at KTC, because it has no yield opportunities sort of outside of borrowing money. So usually they have the two main mechanisms they use to create more of the asset per share is either borrowing money, leverage, and they usually do it then when like the share price is high, because then it's attractive. Or they use like yield opportunities, let's say on-chain or staking. Like with Ethereum, you could do staking, but you could also use it within DeFi to get additional yield. So like I would say, if you talking about a Bitcoin DAT, the only thing is more leverage, less leverage, and then of course how good the governance structure is. If you look at token structures, it can be very differentiated, because like one, the amount of sort of risk you take or not can very much wider, but also the type of strategies, like there's much more ways to differentiate.
Quickly before Shindani kicks us off stage, could you do crazy? I wonder how crazy are the things that people could do with these. Like, I want to know how far on the risk curve can they go? Could they go take their Bitcoin and buy like a casino, and then say that, well, we're buying the casino and then we're going to generate yields by more Bitcoin?
Yeah, 100%. Like right now, and I think you'll see it. I think as things evolve, like I think what we call a DAT will become something that's kind of pure play. But you'll see I think you're going to see it go both ways. You're going to see companies like, call it GameStop. They're going to start building a treasury of Bitcoin that they basically just treat as cash, and they already have. And you see other companies that will start to do the same thing. But you're going to see it go the other way too, where you see these large DATs that have raised so much money, they all of a sudden decide, okay, I'm going to become basically a SPAC, effectively. Like, and rather than maybe they acquire a business, or maybe they just build a business in house that's in that vertical too. And that they I think you're going to see it go both ways. So there's definitely different kinds of DATs, but it's all evolving so quickly because you built up so much capital in a lot of really concentrated ways. So
Are any of the DATs just doing straight leverage? Like, because that's what a lot of these are. They're just they're, maybe I shouldn't say just, but primarily these are like sophisticated leverage plays, right? That are supposed to be less risky than just going 3x on, margin on Binance or something. But so they have like, the loans are dated longer and they're convertible, so they don't get whatever. But could they, and are any of them to get? Because I think the newer the DAT, the more risky they seem to have to be. And some of these plays that are coming out are more risky. We had a team pitch at Bit Angels that was doing. They were trying to do the MicroStrategy play for MicroStrategy. So instead of acquiring more Bitcoin, they're trying to acquire more MicroStrategy. And it was the funniest pitch we ever saw. If anyone was here in Bangkok last year for that. But I thought it was a joke. The guy was like, we're going to do 100x, MicroStrategy. We're going to get more MicroStrategy. And I was like, this is crazy. And I spoke with this gentleman in his team afterwards, and actually didn't, the way they explained it, I forget. It wasn't that crazy what they were saying. But my brain goes, okay, this is like,
I mean, this
on leverage, still about Nakamoto trust and Nakamoto, right? Like Nakamoto is kind of going there. Well,
it's been.
Well, the way that their model is a treasury of treasury companies. Like that's what they've done. They have this diversified basket, and as they grow, I'm 100% sure you're going to get a little bit more creative about how they build that out. So,
yeah, the short answer is you could go as crazy as you want. You could make a big basket of other DATs. You could take out a lot of leverage, and for sure it will happen. But I think I actually don't think that makes sense. One, to kind of diversify away from one core asset. By that point, just create a fund. It's a much better structure. But I also think the vanilla DAT, even though maybe like it sounds like kind of a boring, meaningless innovation, is very useful. Like it's a very useful addition to the product offering to an asset. More so than, for example, futures, which is also useful.
Why is it different than, if it's vanilla, why is it any different from the more traditional crypto ETF?
Right. Okay. So the crypto ETF, you have sort of clean, let's say, regulated exposure to the underlying asset. What I think, well, first of all, if you don't have an ETF, a DAT is perfect because it suddenly also fulfills that sort of accessibility aspect that normally people only have an ETF. Suddenly you can get it in your brokerage account. Institutions can buy it. But let's say you do have an ETF, your Bitcoin or your Ethereum. And then what
10 seconds. What we got to
okay, she fast. Okay. I bring this home in 10 seconds. You have the choice, a Bitcoin ETF or a Bitcoin DAT, or maybe Ethereum, better example. And then you say, okay, with the Bitcoin ETF, yes, it's also in my brokerage account, it's regulated, and in my with the DAT, I not only make a bet on the price of Ethereum, but I also make a bet on the scheme to increase the amount of Ethereum per share. So I hope to go up more even than with just the Ethereum exposure. And where it differs is that, yeah, like I gotta cut us off.
Where do you
For
find
you guys, anywhere here, just like I'll be walking around here. So
All right. Thanks, Rock. Yeah, anywhere here. Yeah, we're Luxfolio. We trade on the Canadian exchange under LUXX, and in the US under LUXXF.
And you guys are raising right now.
We are. We're going to be closing a $10 million placement here probably in the next 2 to 3 weeks.
Awesome. Thanks, guys.
thanks.